Thank you very much for the organizers. It's a great honor to be here. I must say, though, that the original invitation had me for a different topic, so it was a big surprise to me when I see the agenda and I was assigned international crisis. Now, it doesn't matter very much. I would have talked about the same different first slide. It's just a different slide, no?
You actually said something like that.
Okay, you're right. So what is it that I want to talk about? I want to provide, try to provide a unified view of some of the main global macroeconomic events of the last 2 decades. And the concept I'm going to use to unify this is something I'm going to call risk-centric. It's nothing very special. I'll tell you in a minute what it is. And I'm going to I'm going to do this by illustrating a sequence of models that are sort of chronologically organized, more or less chronologically organized, with the events that justify those models. Okay, so what do I mean by risk-centric? Let's get this out. It's a productive capacity, generates goods, but it also generates risk. And it's important that both be absorbed. So you need to find a demand for goods, but you also need to find a demand for risk. Now, the normal way macro models work is for the typical business cycle, is we worry about the top row, and we try to look for a demand that is more or less aligned with the potential output. And the risk side is something that half of this room does for a living, finance, but we macroeconomists care a lot less about. Now, what do I mean by risk-centric? By risk-centric, I mean there are times, and those are the events I want to talk about, when really it's the bottom row where all the action is. And most of the stories we want to tell about the macro side really find their origin and their solution in really the bottom row. Okay, and the typical problem is, the kinds of things we want to talk about, a situation where sort of the production or the perceived production of risk in the economy is much higher than the willing demand for risk in the economy. Okay, so I want to, with this sort of perspective, talk about emerging market crisis. So I want to start in the late 90s, global and developed market crisis, and I'm going to talk about weak recoveries, global spillovers, and if I have time, I'm going to talk about the present. I have many more slides than time, so I will judge by your face expression whether sort of what do I want to skip or not. But I'm not going to skip everything. Okay, so let me start with emerging market crisis. I do see some people sleeping already before I start, so I'm going to discount those of you that are sleeping already. So. So emerging market crisis. So I want to step back. I share much of what Carmen said, but I want to step back to sort of, I want to use this risk-centric perspective to talk about sort of cyclical phenomena, but also about the structure of these economies. And I think a fundamental feature of emerging market economies is that they're pretty good at producing, most of them at producing goods from capital, but they're much less good at producing financial assets from capital. So there is always a shortage of tradable assets in the economy, okay? Risk has to be mapped into assets to be eventually traded. Well, that process of mapping risk into assets in emerging markets is very imperfect. So there is a very small share of tradable assets, certainly not enough to satisfy the needs for a store of value in the local economy. So how do you solve typically this need for a store of value in the local economies? Well, there are two ways, really. One, you save in Miami. I'm Latin America, so that's where you send your money. Once you save in Miami, but very quickly you realize that, well, the return of the deposit account in Miami is pretty lousy relative to the kind of returns you can obtain locally or relative to the rate of growth that the local economy has. So that creates immediately a gap, a very natural gap, a sort of dynamic inefficiency where bubbles are very likely to emerge. Okay, so that's the other way. So there are times in which we're sending the money abroad, and there are some times in which really we convince ourselves of one story or the other. Bubble is a generic name for different things we have, and then the capital sort of flow into the country. And these bubbles, of course, occasionally crash. And again, the different names they take depend on the specifics of the event. But that's a life in an emerging market. In fact, I was looking at the list that Carmen gave. One of those crises, I don't know, was 20s or something like that. It was the Chilean crisis in the 80s. That's the reason I studied economics, actually, because I was planning to do something else, but my opportunity cost in Chile was very low. So I decided to migrate. So lots of things happen around this kind of things. Now, Arvind Krishnamurthy and I, after the crisis of the 90s, sort of began to think about sudden stops. And I think the common denominator of many papers we wrote about this issue is really a picture like this. And this picture is just extremely simple, something you have seen before. In the y-axis, what we have is the interest rate, the dollar interest rate, and the dollar interest rate in the for that particular country. And in the horizontal axis is output, but output is a function of credit, loans, and things that are collateralized by whatever liquidity you have. And the downward sloping curve is a constrained demand for loans, and therefore I can map it in the space of output, which is a decreasing function, of course, of the cost of international liquidity, I star, and of domestic liquidity, which I call ID. So, and those two pictures have the same things on the axis, the same elements. One of the conventional views that we found at the time was sort of what we call the horizontal view. The horizontal view simply models a sine stop as a sine shift jump in the spread of the country, in the credit spread of the country. We thought that actually a better description, and having faced one of these things, a better description actually was something like that, a vertical perspective, if you will. That is, you think about the crisis not as an increase in the price of borrowing externally, but just an incapacity to borrow externally at any price, okay? Of course, you pick the right shift, then the two things give you the same. You get, well, in both you see an increase in the spread, in both you see a contraction in output, in both you see a contraction in loans, and so on and so forth. But that's where the similarities stop. One big difference, which is crucial, and I think is very important for people that sort of live in developed economies to think when you think about emerging markets, is that look at what you can do in the horizontal view when you have an expansion of domestic collateral or domestic liquidity. Well, that shifts the demand to the right and output rises, okay? What happens in an emerging market when you sort of shift the domestic liquidity in the middle of an international crisis? Well, you're not going to be able to affect output very much, loans very much. What happens is the price of international collateral to domestic collateral simply rises. Okay, so those are very different lives, and actually central banks do very different things facing crisis in the emerging markets and in developed economies. In emerging markets, you typically see central banks hiking interest rate, not lowering interest rate. This explains you part of it. There are many reasons why that happens, because the cost is not that high. In an emerging market, there is in a developed economy, there's a big trade-off. That trade-off doesn't exist in emerging markets. So one picture to come up with one caricature to come up with is that in the horizontal view, the conventional view, sort of liquidities, domestic and international liquidity are very good substitute. In an emerging market, they are not. At these times, in good times, they are, and that's part of the problem. We interpret in domestic collateral if it were international collateral, and tell us this is no longer so. Okay. Now, the real question we wanted to answer was not that, but it was the ex ante question. Is, well, I mean, if these countries, you know, after there's a long history of these things happen regularly, why doesn't the private sector do enough about this international crisis? And our point there was, well, the same financial development we're talking about is also responsible, partly responsible for that. There are many reasons. It's partly responsible for that. Why is that? Well, because the reward for whoever is going to lend in international liquidity in a crisis is, you know, the price it gets in terms of the price it gets for that. But when the domestic collateral is very limited, there is very little paying capacity for that international liquidity. So despite the fact that you see a jump in the price, is much lower than the social value of that unit of liquidity, international liquidity. You know, the financial system cannot really exploit that. And as a result of that, the anticipation of this lower price and the social value, obviously, as you saw from the work of John and many others in this room, that's going to lead to sort of underinsurance. No? There's going to be too little insurance, which means when the crisis comes, the vertical constraint is going to be too close to you relative to what the social planner would have done. Now, this little picture can explain many things, and we wrote many papers related to that. You can explain one reason for the dollarization of liabilities. You can explain real estate booms, excessive real estate booms, and so on. And you can also explain some aspects of fear of floating. For example, as I said before, a central bank here doesn't have much of an incentive to be hiking rates. If you actually just use a uncover interest parity condition, I can replace the interest rate there for the exchange rate there, and then you see what happens to a central bank. A central bank in an emerging market facing a liquidity crisis, if it chooses to relax domestic monetary policy, it won't have much of an effect on output, but it will have a big effect on the currency. So what you normally see is the opposite. In Argentina a few weeks ago, what you see is, you know, interest rates, they raise an interest rate to 40% to try to contain the speculative attack on the currency, because there isn't much you do to output, as you were telling me a few hours ago, Guillermo. Well, the problem of that is that the anticipation of that phenomenon, also this fear of floating, also leads to even more underinsurance, because the private sector knows that you're going to do something about the currency, and that fits back into this. Mike and Ben actually asked us to write a paper about inflation targeting using these views, and the main conclusion for inflation targeting is what you should do is really overweight non-tradable goods. Therefore, don't look at the exchange rate very much, and that modified inflation target actually can solve some of the incentives. I think of those things actually as useful for little Chile, not for Argentina, Venezuela, and so on. So you have to, inflation targeting, modifications to inflation targeting is not going to solve the Venezuelan problems, Argentinian problems, and so on. But Guido and I also wrote about overvaluations. Carmen was talking about overvaluation. Well, the same and the insurance lead to a sort of overvaluation. When you have a currency that's overvalued, you essentially stress the balance sheet of the export sector. Well, the export sector is exactly what you will need if you get into a sudden stop. That's part of your supply, of your availability of international liquidity. If that sector is very distressed, which an overvaluation will do, then it's going to be much harder to have a recovery out of that. Another topic I want to discuss, I don't want to say much about that. A big issue for emerging market is also where do these factors come from? Where do these capital flows come from? Is it a reason, a story that we invented locally to generate the bubble, or is it something that is coming from above? Is a pull or a push factor? And one of the big push factors, which actually is very relevant for today, because we don't know whether it's going to unravel now, is the reach for yield type phenomenon. Okay, and so Alp Simpson and I wrote a recent paper in which we show that even if capital flows are fickle, you want to sort of have an integrated capital market, and that dominates most scenarios. But there is one exception to that, which is when the expected return in developed markets and domestic markets is sufficiently different. There's a point in which actually the benefits get overwhelmed by the cost of this potential sudden stop. In other words, you get reach for yield can give you situations where you're going to have excessive frequency in sudden stops as a result of that, and that's one of the few exceptions. With pain, I say you may want to tax capital flows. Policies. Well, these countries accumulate reserves and they do it in a very poorly way, and that creates some systemic problems, but let me move on. Let me talk about now, from this perspective of emerging markets to developed markets and global crisis. The first thing I want to say is that this phenomenon of sort of lack of a store of value is something that has been also present to some extent in the global economy. What I have here is a picture I presented a long time ago. That's the reason it's so outdated. Is what I call a conservation law of bubbles. I mean, if you look at the global economy, you saw the Nikkei bubble, boom, it crashed. Then you got the emerging market bubble. Then it crashed. Then you got NASDAQ crash. Real estate, emerging markets, we know that those crash as well. So we have seen sort of this recurrent sort of phenomena of high asset valuation. But I think what has been particularly interesting of the recent time is that this sort of lack of the store of value has been very concentrated in the market for safe assets. Okay, and I want to build on that. So the one big topic that emerged from that was in the early 2000s, and that's what I'm up to before the crisis. One big global topic was the global imbalances and the declining interest rate. People talk about the Greenspan conundrum and stuff like that. Well, it comes very naturally from that perspective, and that's the view that we took with Emmanuel and Pierre-Olivier Gourin-Shah. We essentially said, well, look at the bottom box out there. People were talking, obviously, we were talking about the current account. They were talking about things in the goods market, trade, like Trump today. And we said, no, look at the bottom of this stuff. The issue comes from the capital market. These guys are very bad at producing assets. These guys are very good at producing assets. And if you want to look at safe assets, you had local central bank and so on demanding assets here, then these guys are very bad at producing it, and now happen that they're demanding a lot. They're scared because of the last crisis and so on. And the US is very good at it. And so we explain essentially some of this phenomena, both the global imbalances and the low interest rate in terms of the gap in this lower box. We use actually a Metzler diagram for that, equilibrium in the asset markets in developed economies, emerging markets. And something that I think is important here, well, again, safe interest rate in autarky is higher in developed economies than in emerging markets. So naturally, when you integrate, you get a current account deficit here, a current account surplus there, and the interest rate somewhere in between. But I think the most interesting part of this picture is this downward sloping looking arrow here. And the reason that arrow is looking downward is because this part of the world is growing at a much faster pace. I think Ken said that this morning, at a much faster pace than this part of the world. So very naturally, unless sort of the financial development accelerates in this part, very naturally you get a tendency towards lower interest rate. Now, one discussion at the time, it was very much a concern that the US would run into sort of an emerging market type event, a sudden stop. I never bought into that line. I never thought that this was a real issue, because one of the big issues for emerging markets is that if you don't like little Chile, you go to little Argentina. There are lots of substitutes. That's not the case for the US. So I always said, well, there isn't enough French real estate sort of to relocate all the demand for safe assets that you have for the US. Okay, but that doesn't mean that this imbalance was not critical for the crisis that we saw. And I think essentially there were at least two steps, some of those have been mentioned actually today, that sort of transformed this international problem into the subprime crisis and the global financial crisis. Of course, again, there were many, many ingredients. So in a paper with Arvind Krishnamurthy again, what we did is the following. We just look at the case of the economy that is absorbing this demand for safe assets, the US in this case, and we asked the question, well, suppose that there is no sudden stop in the sense that these flows come steadily in and they never go away. But let's think what happens in an economy that has its own domestic shocks when you sort of have these flows, the steady flow of demand for your safe assets. What happens to the domestic financial system? And what you see here is a simulation from that model. What happens here is the capital inflows start at date 0, the economy is doing well, good shocks and so on, and at date 6, the economy starts getting negative shocks, okay? And so what you see here is that initially, obviously, the interest rate declines, asset prices actually go up, on risky asset prices go up initially, the risk premium actually falls because this steady capital inflows are actually stabilizing the fluctuations of wealth in the local economy. So you see the risk premium falling, not rising. There is a confusion there. Even though the flow is for safe assets, that stabilizes, it produces a sort of a period of low volatility. And so that's what you see. And obviously, when the shocks turn negative, the thing turns around quite dramatically because your system is very levered. So what it does is very natural. If you're selling a tranche of your safe asset, you're tranching out your safe asset, selling it to the rest of the world. When you get hit by mega shocks, that's going to lead to a much larger event. And so I think that, so the effect of that imbalance that I described before, through leverage of the domestic financial system, had a very important effect. And I think that you can ask the same question we asked before for the emerging markets. Are they underinsuring? Here in the case connecting to the work of Helene and Pierre Olivier is the US being too much of an insurer or last resort to the rest of the world? And probably the answer is yes. But I think it required more to get into the crisis we saw in the US, and I think the talk that Gary gave in this morning, so I thought it was very related to what I'm going to say here. I think the second aspect of it is that the form the leverage took was very different from previous forms of leverage. It was done through very complex instruments with lots of tranching and so on. And so there was great confusion. Gary said this morning, one of the characteristics of new crises is that, you know, they come from new forms of short-term debt. And the point that we made with Arvind, this one point actually, we wrote this paper before the crisis, was published in October 2008, so very timely, very lucky. But not that we anticipated this stuff, we had no idea what was coming, but we wrote the paper before. And the idea was there very simple. It says, well, there are shocks when something new breaks up, where we don't have a history really of historical data to analyze. Well, that leads to reassessments of models and so on. And when that happens, things get to be a lot more dramatic because agents don't know who will get the risk. So you start getting lots of double counting in the economy. So the perceived box of supply of risk sort of widens dramatically, and that leads to very extreme forms of safety quality. So what's the newest aspect that Gary talked about that we were trying to model here? And then with Alp Simsek, we went one step further, and we talk about, sort of, we look at the financial networks, and we ask the question, well, how different is a shock of similar size when you understand the linkages of the network, when you don't understand the linkages of the network? And the difference are sort of pretty dramatic responses where you get massive flight to quality in events of that kind. So again, I don't think it was an emerging market sudden stop, but the international aspect, the type of assets that were being demanded from the US did contribute to some of the things that we saw in the crisis. I'm going to skip that. I want to skip policies. Let me talk briefly about this. Now, when you connect the arrows of the lower boxes of the risk part to the goods market, there are sort of several ways of doing it. The most typical way we do it is balance sheet mechanisms. And those operate through the supply side of the economy typically. They can operate through the demand side, but they typically operate through the supply side. No? There's some financial constraint that gets a lot tighter as a result of what is going on. What we did with Emmanuel first in the concept of closed economy and then with Pierre Olivier in the concept of an open economy, is add an aggregate demand channel for that connection, okay? And what we said there is, look, we have been talking for a while, something that Ben was talking also for a while, about the sort of this declining interest rate and safe interest rate and so on. And while initially the risky rates also decline, the equities risk premium even decline, at some point it began to broaden actually before the crisis, widen before the crisis, and then with the crisis exploded a lot, and then interest rates went to the bottom to zero, trying to sort of accommodate, I see conventional monetary policy in this perspective as simply trying to increase the Sharpe ratio. So people demand more risk than the economy is producing. Well, there's a limit to how much you can increase the Sharpe ratio through this channel. That's the reason you go for other policies, and that wasn't enough. Since that wasn't enough, then you get into a standard sort of liquidity crisis type situation, which is what we did. So even if you don't have boxes of different size, if what people want is a lot of safe assets and really the economy is not producing the combination people want, then you end up with a situation where you have a problem. And this will contaminate here precisely through an aggregate demand channel now, and that's consistent with what Atif was talking about. And in fact, one characterization of what we did there is just with this conventional Keynesian cross type model. You can map that model into this, and you can see sort of the supply relative to demand, but the supply of safe assets is a shifter of aggregate demand. So if for some reason this Italian debt is no longer part of safe debt, or AAA tranches is no longer part of safe debt, that naturally sort of depresses the aggregate demand, which you can offset for a while with interest rate, but if you don't have interest rate to play with, then that's a contraction in aggregate demand. So we integrated there these risk premium shocks that we saw with sort of more traditional, if you will, aggregate demand channels. Yeah. And then with again, as I said, we merged forces with Pierre Olivier, and what we show is that in an environment like this, we call them safety traps because they come from a shortage of safe assets, and because the type of policies, something I'm not going to have time to talk about, but the type of policies that the safety trap is responsive to is different from the type of policy that a liquidity trap is responsive to. But anyway, let me skip that. But the point of this diagram is that at the global level, safety traps spread very quickly across countries that have very low interest rate. And in fact, by the same token, anything that any country does to get out of that safety traps, aside from depreciating the exchange rate, helps everyone. And so there is a lot of problem of coordination of policy. This is a place where you want to coordinate policy, but there's no incentive to do that. There's a lot of free riding problems. And the most extreme of those is in the concept of the currency. Obviously, you can think of this as a global equilibrium, there is a one safety trap that the global economy has absorbed. The allocation of that global safety trap depends on what is your real exchange rate. And of course, there's lots of incentives to play with that. That's the present. I'm not going to talk too much about that, but just to say things to relate to the, what are you showing me? Okay, 1 minute. What I wanted to say is this is work with Simsek, very recent work. What we have here is an environment very similar to what I just described, except that we had complete markets, but we have a topic that John likes a lot. What we have is speculations. You say, in an environment like this, if you are in a world like this where interest rates are very low already, suppose you add a speculation on top of this. What happens? And the result is that you get an aggregate demand externality, and so there's a strong incentive to do macroprudential regulation. And the reason you get an external externality is related to things that Andre likes, is that the economy becomes very extrapolative. People that bet positive do very well in booms, people that are negative do very poorly in recessions, but it happens that you need the optimist during the recession, and that can lead sort of very negative downward spirals, which justify macroprudential regulation. I'm going to skip all that. This was to tell you, don't tax capital flows. Unless it's rich for yield, extreme, don't do that, because that works the wrong way, because it lowers equilibrium real interest rate. You don't want to do solutions to things that going to end up lowering the natural rate of interest rate. That's not what we need at this time. And so let me conclude just with I don't know if it's a pessimistic view on things, but I think it's somewhat paradoxical. If you want to get a caricature of the story I've told, is that as emerging markets have become more prudent and therefore have demanded safe assets from the rest of the world with respect to sudden stops, together with the fact that they're growing faster than the rest of the world economy has become more EM-like. So I think we live today in what I would describe as an advanced emerging market economy. And that, can be exciting, but it also has some problems. I think that the two characteristics that are very prominent and with their implication is this chronic shortage of assets, especially safe one. We tend to see that at the global level. And the other one is that conventional monetary policy is far more constrained. In emerging markets, was constrained for a different reason. An emerging market is typically constrained because you're protecting an exchange rate or because you're very worried about inflation expectations sort of spiraling and so on. In the developed world, it's simply because interest rates are so low that we're very close to some sort of effective lower bound. So let me stop there.
Good.
I'm done.
Great.